as I was saying, this core financial insight is on the third part of tax efficiency. Okay, these 20 core financial insights, 5 were on insurance. That's going to be 5 on investments. That's 10. We took 3 for tax efficiency. All right, because it is important. Like I told you in the imagery that I painted for you, your financial house on a bedrock foundation with tax-efficient walls and a debt-free roof. You pay attention to the debts, you pay attention to the tax-efficient, to the taxes, okay, to the insurance, and you're halfway there already, okay, in terms of avoiding financial hardships and attaining financial freedom. So today is the third session in the tax efficiency part. How do we become more tax efficient? How do we pay less taxes, right? So the first one we did was on how do we make tax-free income, and we talked about 3 things there. The second session we talked about if we cannot make tax-free income, how do we pay taxes later? How do we make tax-deferred income? And we talked about 3 things there. Okay? The other thing that you need to pay attention of, or at least get a sense of, so that you can plan things properly, in a tax, in a way that's beneficial for you, is to just have a sense of how the tax rates, tax structure works. Okay. Once you get an idea, then you can plan things, better. Now, let me give you a disclaimer before I go any further. I'm not an accountant nor a tax lawyer. Okay. All I'm trying to do here is to heighten, create awareness and heighten your sensitivity to these things. Okay. And what you need to do when you're ready to implement any of these things is to sit down with a qualified accountant or tax lawyer and do this, okay? But for most of us, if you have a good sense of this, then you can plan your year, your various sources of income, so that you don't get thrown from one tax bracket into another necessarily, all right? All right, with that, let's come to today's topic, which is tax brackets, income tax rates, tax levels, right? Income tax. So first thing is, let's talk about some history here. In Canada, there was no income tax until the First World War, 1918, okay? And income taxes came in as a temporary measure to help with the war effort, okay? Prior to that, as opposed to the UK or the USA, the Canadian government did not want to have income taxes. Why? Because they wanted to attract immigration, okay? They wanted people to come here because it was an incentive for them to come because there were no taxes. But when the war broke out, they didn't have a choice, and they did as a temporary measure. But when governments get used to revenue, okay, it's not only has been a temporary measure, it's been increasing because they gotten used to the revenues that are there, right? So that's a bit of history. The department that administers in Canada the taxes is the CRA, Canada Revenue Agency, and it's done on a self-assessment system. Okay, every year you are supposed by the deadline that is there to file your own taxes. Okay, and when they receive when you file your income taxes, they will send you an assessment, a notice of assessment, and you can either object to that or you agree to that. Okay? But that's how the system works. That's the department that does it. We in this country pay taxes at 2 levels, at the federal level and at the provincial level. In the common law provinces, meaning every other province and territory except for Quebec, it is the federal government that collects both at the provincial and at the federal level, right? Provincial and federal level. In Quebec, if you've had the occasion to live in Quebec, and I have for 17 years, we file 2 income taxes there. My lovely wife is from Quebec, so we lived there for 17 years in Quebec. And in Quebec, you have to file 2 tax returns, the Quebec tax return and the federal tax return. It's not just one tax. It's a nightmare there. It's crazy. That's why I left. It's great. But it gets bogged down. But Quebec is always different in everything that they do. But they are the ones who you actually file 2 tax returns. Okay. and they disagree with each other on everything except taxes. They liaise when it comes to the taxes. I know that because I had an audit once, and one told the other one, and so I had to pay both sides. All right. We pay taxes at the personal level and at the corporate level. The reason why I'm bringing it in is one of the strategies that we're going to talk about is incorporating if it's feasible for you, okay? And the reason why. Okay, so we pay taxes at the personal level and at the corporate level. We pay tax on taxable income. It doesn't mean that you go out there and earn money, you're going to have to pay taxes on it, okay? There are deductions, there are exemptions, and it's only on what comes out as taxable income that you pay taxes. So generally, I can put it this way, because of personal exemptions and various exemptions, you really don't pay taxes on the first $10,000 of income. Okay, so you could go out there if you are a part-time worker or something like that. They will take money at source. If you're an employee, they will be deducting money at source. But when you file the taxes, you'll get it all back. So on the first $10,000 of income, chances are you won't have to pay anything, okay, because of personal exemptions and various deductions. But if you make more than $10,000, and we'll look at tax rates in a second, that's when the taxes become payable on taxable income. So just be aware of this, okay? It's based on taxable income. So why bother? You have to bother because of the way these rates climb, okay? It's called a progressive tax rate. The more you make, the more you will pay, right? And so you need to know, because you will jump from one bracket to another bracket as your income increases, okay? So you necessarily need to have a sense of this so that you can plan accordingly, okay? If you can delay earning certain incomes, if you can reduce your income, your taxable income for the year, it just keeps you in a lower bracket versus throwing you into a higher tax bracket. So the progressive tax rate. Here are the 2012 personal income tax rates at the federal level. Again, I want to qualify, this is on the taxable portion of your income, not on your gross income, okay? This is after you take out all the deductions and all the exemptions, whatever is remaining that you need to be, that's taxable income, this is what we're talking about. On the first $42,000 of taxable income, the rate is 15%, okay? That means to say that if, on the first, let's just take a number there, 40,000, 15% of 40,000 is 6,000. On that tranche, on that layer, you will pay $6,000 if on that 6,000 in taxes. On the next layer, from 42,708 to 85,000, you'll be paying 22%. So let's use another number here. So just go in chunks of 40,000, okay? On the first 40, you pay 15%, that's 6,000, right? On the next layer, let's say I made 80,000. On the next layer, because it falls within that range, on the second 40,000, I pay 22%. So now it's 8,800. So on the first 40,000, I pay 6. On the second, I pay 88. See, it's progressive. It gets more, right? If you make more than 85,414 in that range, let's say we keep it at 40 in chunks of 40 here. On that next 40,000, on the third $40,000, I'll be paying 26%. Yeah. See how it goes up? And then beyond 132,000, you'll be paying 29%. This is just at the federal level. Okay. Now in Nova Scotia, the progressive tax rates go like this. They have, I believe, four layers. On the first 29,590, it's 8.79. Then it's 14.95. 32 to 57,000 is that. And then right up to 150,000, it's 17.5. So what happens is your taxable income, whether you do this using software or you do this using paper, when you worked out your taxable income, then that's when they slap those rates, the tax rates, okay? So if, let's say, you were making more than 150,000 at the federal level, it would have been so let's just at the federal level, at the highest level there, if you notice, over 132,000, you would have paid 29. Okay, if somebody was making $150,000 at the federal level, they'd be paying 29%. Okay, then at the provincial level, 150,000 and over, 29, and then at the provincial level, another 17. Okay? Almost 47.5% of your money is going into taxes. So is it important that we pay attention to taxes? Of course. Okay? Because otherwise you're spinning wheels. Okay? You go out there, you earn money, and half of it is going to taxes. All right? So how, anything that you can do to minimize, reduce taxes, we want to be doing, right? And one of the reason why I wanted you to be aware of this is because sometimes in the course of your year, you might have more than one stream of income. Okay, you might be doing some consulting on the side as another source of income. It might not be a good idea if at all possible, delay that for the following year or at a time when your total income is lower, instead of taking it all in one year and then finding yourself in a higher bracket. That's one way where if you can delay income, delay it, okay, into another year. Second way is if you find that you're in a very high tax bracket, use those tax shelters that are available to you, RSPs, RESPs, and TFSAs, okay, particularly RSPs where you can bring it down. And then if you run a part-time business or otherwise, there's ways to to bring the taxes down. Okay, and if you are already into investing and if you've suffered losses, you can trigger those losses. Okay, to help reduce it. Okay, marginal tax rates. Now, once you understand that there are different levels of taxation. Okay. This idea of marginal tax rate, once you are in one bracket, okay, your marginal tax rate means that as soon as you make another dollar that pushes you into the next rate, that's your marginal tax rate at the margin. You follow? And it's based on the income level, and it's also based on the type of income. Okay? If you make salary and interest, there's a certain marginal tax rate because those incomes are taxed differently than dividend income or capital gains. Capital gains, you don't pay tax on the entire capital gain. You only pay tax on one half of it. Okay? And in dividend income, because of the dividend tax credit, there's a different treatment, but generally you can state it like that dividend income is about 67% taxable, not 100% taxable, okay, with the dividend tax credit structure that they have. Right? Now, the highest marginal tax rates in Nova Scotia, if you earn salary or interest, if your income just keeps increasing, the highest marginal tax rate, remember we looked earlier on, almost 49, 29 plus 17, okay? For salary and interest, it's 50%, right? For dividends, it's 35%, and for capital gains, the maximum you'll pay is 25%, the highest rate, right? Now, the lower the bracket that you're in, it'll be lower. So the idea here is not to throw yourself into these higher brackets, because if you do, this is what you'd be paying. Okay? Average tax rates. Go ahead. Right.
So you pay 8.79% on the first $29,000 a year. But if you say your salary is $32,000.
Mm-hmm. Joe, can I just interrupt you for a second? Can you give them one from the back and one from the front? Sure. So go ahead, Joe.
I'm not sure if I can explain it clearly, but so let's just round it off at 30,000. So it's 8% on the first 30,000. If you make 32,000, the 14%
only on that layer.
Only on the extra amount.
That's right.
So
Yeah.
it's not like you're actually losing money by earning more.
Right.
Because you're not increasing how much you're being taxed on the first 29,000.
Oh, no. The first 29,000 is at that level. Okay. It's on that second layer that you pay the higher amount.
Right.
But the point is, you don't. If there's anything you can do not to throw yourself in the high. I mean, I'd rather be paying 29% than 32%.
Right.
Okay. For smaller, when depending on what you do for a living, right? If depending on the amount of money we're talking about, it can be substantial and it adds up. So we're trying not to do that, and especially when there are things you can do. Okay. For instance, I give you an example. If you are getting a bonus at the end of the year, if you're making some arrangement, right? If you're earning money in December, why get it in December? Delay it till January. Then it doesn't get reported in that year. You follow? If you come at the end of the year and you realize that because of overtime or because if you're self-employed, it's been a good year, right? You've got to find ways of having more legal deductions, of course. We're just going to throw expenses or whatnot in there. So if you are a salaried employee, for instance, and you've got RSP limits, right? Consider using it. Yeah, that'll bring it down. Just bring you down to the lower level, right? Does that answer your question?
Yeah, I think so. If you put that money into the RRSP,
Mm-hmm.
then you're essentially not going from one bracket to the next.
You're not, because the RSP gives you a deduction, so it brings you down to the lower one, and that's what it is. Okay, and the idea of the RSPs was so that when that, in theory, that was the idea, because most people by the time they retire, right, they would be they'll be functioning on a fraction of their previous incomes at a lower tax bracket. So that's when you want to start pulling the RSP money out. Does that make sense?
Yeah, I'm just trying to picture out that, if when the government sees how much income you're paying,
Mm-hmm.
and say I'm $2,000 over a certain bracket,
Right.
then they see that I actually taken $2,000 and I put it in an RSP, so then they subtract. They see that
Oh, yeah.
have reduced.
Yeah.
Okay.
They want you to do this.
Right.
Because the planners way back when they were planning these things out, I mean they didn't give up those revenues. They're giving up revenue. You realize that, right? But the intent was to help you save for your retirement. Okay? This is why they allow you to do, because this is what they want you to save. And they are foregoing revenue. They know they're foregoing revenue because you fall into a lower bracket as a result of that. But they're willing to do this because they know that if you come to the end and you have no means, you're going to be dependent on them, on social assistance. And they'll end up paying anyways. Right? Does that answer your question, Joe? Different layers? Any other questions on this? So average tax rate, I just wanted you to be aware of what people mean when they talk about average tax rates. The average tax rate will be you take your tax payable at the end of the day when you've done all your calculations and worked out the amount of tax that you paid by your taxable income, that's your average tax that you're paying. So basically what it is because, like Joe said, we have got different layers. At different layers, we're paying different amounts of taxes. Okay, this is an average of all of that. You follow? First level, you're paying 29. Second level, you're paying 32. So you take the total taxes you've paid over your taxable income. You come to an average tax rate. Okay, your average tax rate is not your marginal tax rate. Okay, the marginal tax rate is what you would pay once you move into the next level, right? And you want to be aware of that, because if you are at the second level, then your marginal tax rate will be the tax level at the next rate. So the tax, at our level, all we want to make sure is that, if at all possible, we want to avoid going into the next bracket. Okay, if at all possible. Sometimes it's not. Okay, we've just made the money and we've gone there. But if you can delay it, or if you can, use deductions, use them. Okay, and this is one of the ways that we increase our wealth. Because this is there and this is real. Okay, we're not taking any risk or anything to increase what we have. All right. Now, I wanted to bring this out because depending on your situation, more and more, even with in employment, the structures are changing. Used to be, many years ago, you would the usual route would be you join an employer, right, and you stay with them. Okay, so, until and in some cultures that's still happening, but in the West, what has become more common now is on a contract basis. They don't want to engage you, right? They hire you on a contract basis, and then they keep you on a contract for a long, long time, and there's sort of no commitment on their part. Okay, if that's the case, or if your employer entertains that, consider, depending on your income tax, your income level, consider incorporating. Okay, here's why. Because if you have a small business, if you incorporate and if you're running a small business, on the first $400,000 of net income, that means all your revenue less the expenses that you incurred to earn that revenue, okay, all of the legitimate expenses. On the first $400,000 of net income, you're only paying 15% tax. 15, okay. Remember we said marginal tax rate, salary and interest in Nova Scotia, 50%, 15%. I'll give you a few examples here. Many doctors, and it used to be professionals were not allowed to incorporate, okay, because they wanted to hold them accountable. But in most jurisdictions now, I can't think of any where you are not allowed to incorporate now. Most professions allow you to incorporate now. Okay, so if you are allowed to incorporate, and most doctors, for instance, I haven't met a doctor who makes less than $200,000 a year. Okay? I've never met a physician who makes less than $200,000 a year. So if you are a physician and if you incorporate, okay, if you don't incorporate, then as a physician you make $200,000 a year, and depending on what kind of expenses you have, if you work in a hospital, you don't have much expenses because you're not paying for the overhead and whatnot. If you run your own clinic, maybe you do. Okay, you have a receptionist and you've got rent to pay and whatnot. So let's say this doctor makes $200,000 and expenses are $50,000, salary of a receptionist and over rent and all of that. Okay, the net income is $150,000. Now, if this doctor did not incorporate, okay, provincial, using our tax rates, on the first amount he pays, he ends up paying approximately 50% of that $150,000 in taxes, $75,000, right? Now, if the same Dr. ABC, instead of working as an individual, getting the income in his name, he goes and sets up a corporation, which will cost him like $1,000 to set up a corporation, right? For $1,000, he now functions as ABC Incorporated, okay? ABC Incorporated, and now all the revenue goes into ABC Incorporated, right? The expenses are still the same. He's still paying the receptionist and all his overhead and everything else, and the net income is still the same, $150,000. But on that $150,000, because this is a small business corporation, he pays 15% tax. So 15% of $150,000 is what? How much? 22. Isn't 22 better than 75? Right? So what happens then is from the corporation he has to take out income for himself, and if he takes out only about $30,000 of dividends, he'll pay zero tax at the personal level. Because remember I told you dividend income is treated differently from capital gains and from salary. So just want to create awareness here, okay? Some of you might be in those situations, whether depending on the field that you're in, be aware, okay, that if it's at all feasible for you, sometimes, because of the nature of your work, you're an employee and they'll not deal with you enough. I used to have breakfast with an IT professional many years ago, and I suggested this to him, and he went back to his employer and they wouldn't entertain it, okay? They said, no, you can't. We will not deal with you on a contract basis. You are either an employee or, you're not. Okay? They just wouldn't entertain it. But if they do, right, and depending on the kind of money that you make, something you want to consider, okay? Because what's happening with if you take the example that I just gave you, This doctor who makes $200,000 pays expenses of $50,000, ends up with $150,000. He ends up with a tax bill of $75,000. What does he have left? $75,000, right? If he incorporates, and he makes, you know, himself and his wife shareholders of the company, right? Then he, same scenario, $50,000 go out in expenses. The company is left with $150,000, right? Now he pays 15% in tax, $22,000, right? $22,500 in tax. Then from 175, he's left approximately with about 150. I'm just using rough round numbers here. Okay, 150 less 22, 125,000 left. Okay. Now from there, he can take 30,000 out. His wife can take 30,000 out. Both of them will pay zero tax. So they've ended up with $60,000 cash, right? And the company, there's still money left in the company. You follow? Versus giving them $75,000, and you know. So just want to create awareness. Like I said, I'm not an accountant. I just want to create awareness that this exists. Okay, there are people doing it, and if it applies to your situation now or in the future, consider it. Okay, because you know, if you can, like I said again, you know, if you take care of taxes, you take care of debt, you take care of the insurance, you're halfway there. Okay, towards avoiding financial hardships and attaining financial freedom. Okay, half the battle is won already. All right.